Without further ado, gentlemen, it's a pleasure to have this panel with you this morning and the Hacken team putting together really impressive events so far. I mean, those last panels were great. So hopefully we can keep up the tempo. Let's start with introductions. Martin, please, would you kick us off, your background and anything you want to say about your background and yourself?
Yeah, hi, thanks for having me. Thanks to the Hacken team. Martin, a co-founder of Centrifuge. Centrifuge is in real-world assets. We heard that term already a few times, so not risk-weighted, but real-world. Asset tokenization protocols, one of the OGs, so we're around since 2018, and really, if you look at, I think where the market is going today, I've heard the word evolution a few times, and that is super important, where I see actually traditional institutions getting into the tokenization market, adopting the technology and turning the business. And with Centrifuge, I'm more on the revolution side of things, where we are kind of, out of DeFi, decentralized finance, trying to build actually these new technology platforms to decentralize assets.
Hello, everybody. Otonino from DTCC. I'm the Technical Business Development Officer, Director. And I focus mostly in accompanying and overseeing the process of adoption as we transition some of our clients into the new technology, how the things have to map the processes and the redesign to make sure that the implementation goes well. I have had the pleasure of, before working with DTCC and Securities, working in different institutions that have planned to transition into DLT. And that's what makes me familiar with the processes and the complexities that are mapping processes in the old systems into the new technologies, right?
Good morning, CJ Rinaldi. I'm the Chief Compliance Officer for Kraken. Kraken is a digital asset exchange, probably quite familiar to many of you, so I won't go into what our products are. All crypto native, and what we are seeing is convergence, which is certainly a buzzword we're hearing more and more. So to contextualize that, we've now expanded into futures, since we've acquired a futures commission merchant. We also stood up a U.S. equities broker-dealer regulated by FINRA. So my goal and one of my main objectives is to make sure that all of our customers are protected and we maintain compliance with laws and regs across the various jurisdictions where we operate. We have roughly 25 licenses and registrations globally, and that's very quickly expanding. So happy to be here today and talk about compliance, reg, and other risks.
Yeah, I'm actually thinking to myself, I'm still getting used to the fact that we have a panel with DTCC and Kraken, and it makes sense somehow. But I guess that's where we are. But it's very clear now that tokenization is not going away anytime. And so for us on this panel, we want to explore some of the risks and security and some of more of the aspects of it that I think still need a bit of work, and all you fine gentlemen are doing that. One of the questions that I know came up was embedding compliance without stifling innovation. And I think each of you have a really important voice in this, as all three in your own way are disrupting and redefining what that means. So Martin, starting with you, how do we embed compliance without crushing innovation?
I think it's not easy, So the technology allows you things which are actually not possible in traditional markets. We heard a few things, like just to kind of fast forward. On the blockchain, you soon will be able to basically kind of where spaces like traditional banking, payment, checking accounts, saving products, whatever you think, it's actually all merging, and you can basically pay with your broker account. You do not need to translate an asset from an end user perspective through what the technology is allowing you from holding an asset in custody to paying the bill for a hotel or a bar or whatever. You don't need that anymore, So you can actually kind of, you have an asset holding and use that as a bank account in the future, and can completely abstract it away. Just another thing I've just heard recently somewhere, that basically the stablecoin transaction volume has actually already passed the transaction volume of Visa and MasterCard combined. So you actually see the speed where it's going, and it's also super hard for basically regulators to step in and kind of, where you see those different approaches, Europe being the first, most likely going a step too far, creating a legal framework no one is really understanding. Everyone in the European Union, and I'm a German, so really suffering from that a little bit as well, really isn't really understanding that, and is really struggling with kind of, how to execute on those kind of, regulations and compliance frameworks. And on the other hand, what I really like, where other markets actually kind of, most likely opening it more up, giving more flexibility, and actually let's try first and see what works, what not, and from there going forward. And I think it needs the cooperation of I think the DeFi people like me and the more kind of traditional finance institutional market participants to kind of together find the right solutions, because you look at, I think, US security law. It's 100 years now, isn't it? At least, I guess. It's evolving, has improved over time, and it's now actually also most likely need to get it into that next stage of evolution to kind of adopt those technology. And coming back to your question, technology at the end needs to be part of the technology itself. We first time can actually put regulation in code. And that is something we haven't really used yet. So if you look at KYC frameworks, AML, risk and compliance, that can be part of smart contract. That can be part of the technology itself, but we didn't do it yet. Because first of all, the framework is missing, but there's also no real driver to do that. All the technology is built for DeFi, where the assets and the underlying is all crypto. It's all 24/7 anyway. But if you would like to kind of bridge the traditional markets into blockchain, where the source is, that's where the term is coming from, real world, that needs to be bridged. And the risk from what is on-chain, what is off-chain, that needs to be minimized. And that regulatory framework is completely missing, I think.
Yeah, it makes a lot of sense. Otto?
Well, I don't see why there has to be a trade-off between compliance and innovation. Actually, I think technology and innovation can propel compliance in a better way. And thinking better ways to do compliance or to comply with the regulations is part of the innovation, right? So I think the key now is collaboration. It cannot be compliance imposing into the operations or operations following compliance. It has to work together from the moment that the assets and the processes are designed. And that's the key. Right? In innovation now, it's not just adoption, it's really collaborating from the beginning. Stakeholders, as we have heard many times, have to be involved from the beginning, even before the asset is created. So I actually see more opportunity for innovation in the new technology and compliance. But that's how I see it.
I agree. And look, running a platform, we're all about leveraging regulatory technology. We use a lot of artificial intelligence to try to understand, not just to summarize who is a client, but really what are they doing? What are the patterns? What are the transactional activity? What we are seeing, though, is that we are seeing the ability to leverage smart contracts for very important ways. So, for instance, you can code a smart contract to ensure that it is capturing sanctions lists, and so you can effectively, use that as a prophylactic measure as well as a monitoring measure to make sure that the bad actors are not coming onto DeFi protocols, as well as if you're like me and you're regulating custodial exchange onto our platform and to our custodial services. So the technology is definitely evolving. Long way to go. What we are seeing, however, is that a real tension in the regulatory space regarding DeFi. There's a fundamental question which has not been answered. Will we regulate it or not? It's a really, really interesting question. I don't think the Europeans have figured it out. The US is definitely struggling with it right now. We'll see what the UK does. But we are seeing, the seat that I have, we get a lot of requests for information from law enforcement, and their expectation is very clear. The regulators as well, not just law enforcement regulators, their expectation is quite clear that we know who our clients are. So if we're receiving from a DeFi wallet assets, their expectation is we are able to trace the provenance of those funds on chain and also understand to the extent whether there's a potential illicit finance component to it. That's very, very tricky to say the least. Even utilizing blockchain monitoring technologies, advanced as it's become. And that's not just because we have the North Koreans and the Russians, bluntly, who are very, very savvy. They know exactly what they're doing, and they've created all sorts of ways to work around sanctions, controls, and evasion. That being said, the Financial Conduct Authority, I could tell you with authority, will ask you flat out, prove to me that your customers and your customers are compliant with our money laundering regulations. Likewise, prove to me that you understand the travel rule and that you're applying the travel rule with respect to DeFi as well as your clients that are custodial. So that's very, very tricky. But nonetheless, it's a challenge that we need to step into, leveraging technology. And so Listening to the prior panel, it's interesting. When I always talk to people about crypto, I try to abstract away from the technology and just think about the benefits of democratization and real-time settlement and liquidity and what have you. But at the same time, as someone who's a technologist in the compliance space, for me, the technology is really what it's all about in some respects, to make sure that we can leverage it to put in place controls, which aren't bulletproof. No controls are. You're always going to have criminals and people who are quite wily and will be able to evade them. But trying to get ahead, one step ahead, is really the important thing from my perspective. And as we bridge on and off chain, I think it's going to get even trickier.
That's really great. I've never been part of a panel that's grown midway through, so I guess we're doing okay. Charles, I guess the panel was warm enough for you to jump in. Please, I know everyone in the room knows who you are, but why don't you introduce yourself very quick, and we'll get to the next spicy question I have.
Sure. I work at S&P, like S&P Global, like the credit rating agency. We're the leading credit rating agency, the leading index provider. I co-lead the team for all that is digital asset, blockchain, DeFi. We recently raided the Sky protocol. It was the first time we raided, anybody raided a stablecoin ecosystem. We created a product around 2 years ago about stablecoin, and it's called the Stablecoin Stability Assessment, where we look at the risk of depeg of stablecoin. We're very interested in DeFi, institutional DeFi, and we are very interested in the evolution of risk. I can touch on that later on the panel, on how we now have tokenized financial asset, and those tokenized financial assets come with a new type of risk that are more akin to cyber risk. And we have this merger of, or inclusion of new type of smart contract risk, but also the operational risk that come with tokenization. We saw, for instance, what happened with PayPal. They suddenly minted 100 trillion, I think, dollars in their token. It was not exploited, but that's the kind of new risk that you have around the minting, the burning stuff. We'll speak on that. Sorry for joining late.
No, we're happy to have you. I want to get to the titular question for the panel. And I love some of the stuff that CJ brought up around DeFi and regulation, which I'll get into. Risk and resilience for tokenization, the elusively obvious, what does that actually mean? What does it mean for tokenization to have risk management? What are the different types from each of your seats where risk is important? Because I expect a different answer in some ways. And then how do you define resiliency? What does resiliency mean in your neck of the woods? And where do you think tokenization is resilient and isn't resilient? So Charles, please kick us off.
Okay, so our focus from the risk angle will be really in assessing the risk of those the specific assets. For the resiliency, well, there's different angles. So first, for the stablecoin, there's a specific angle on depeg, right? It's not the same to depeg or to just totally collapse. But almost everything we're doing right now start with the quality of the asset, the underlying. Most assets that are tokenized, and many still don't know that, can be rated. Many are rated. We did dozens of ratings, but they're all private right now. So we got around 6 that are public, including the Sky protocol, some tokenized money market fund. But at the core, for us, it really starts with the quality of the asset, and then we start looking at the other layer of risk. So for instance, for stablecoin, the way we look at the risk of stablecoin in the context of depegging, start with the quality of the asset. You get a first number from 1 to 5. You cannot go better than what you got there. But then we have all the other consideration around the regulatory risk, the dependency risk, and many others that are detailed in the methodology. And from that score that you have, you can only go down. So for us, we start with the quality of the asset, and then we start to add all the risk around it.
Yeah, I think as you mentioned already, every product, on-chain, off-chain, has different risk levels, and with an on-chain product, you just most likely add more risk levels. And what we also did in the past together is a perfect reflection of that. When you kind of rated the Sky protocol, part of it is also product protocol, actually assets being issued on Centrifuge, and also partially being rated by S&P, and I think we had Moody's in a room as well. So that is where you can basically say, hey, it's just kind of, break down the different risk levels, analyze the different risk levels, and just make them more transparent on the blockchain. That needs to be the future. And where blockchain can be understood as a use case. Hey, of course, it's adding its own risk levels, but it can be much more transparent in the past to actually make those risks visible, but also actually put them in context and see the impact of what is actually happening on the different levels and how it is impacting the stability of the product itself. And that's also why a lot of the people basically dreaming tokenizing private credit. I'm also one of these. In my past, the startup I had before Centrifuge was supply chain finance. It's a perfect example. If you finance a single invoice, where a buyer is sending an invoice, it's actually receiving an invoice from a supplier. It's a multitude of different risks and credit risks you're basically imposing on a single asset, which is an invoice, which is maybe paid in 30 days or not, and putting that on a blockchain, making it more transparent, and building then actually distribution structures on top, which may end up in a tokenized product where you do not need to care about a single invoice anymore because it's all diversified, it's all part of a much, much bigger product, but you still have the possibility to actually drill down, see the risk of a single invoice, if it is paid or not. That is what blockchain can provide.
I'm going to situate us in the case of the DTCC, which is all about the clearing and settlement and the processes, right? These are processes and systems that have been working and operating for over 50 years. So to me, in that context, resilience is not having the assets depending on the systems and the rails. We now have to bring those systems and rails and processes into the asset. The asset needs to be resilient, not depending on the infrastructure. And that is tricky because it's designing the processes, designing the rails in the structure of the asset. The concept of control and ownership has changed. You may have the ownership of the asset, but not necessarily the control when it comes to smart contracts. So it's really resilient when you can replicate not just the asset structure, but the whole system of operation that it will live into the structure of the asset. And that's key. I mean, it's a function of design. And our industries are not used to design. They're used to follow, right? So it's a big change.
So the dimension that I'd add would be more from a regulatory perspective. And what I would look at is transparency and customer protection. So are the assets provable? Are there proof of reserves? Can you go onto the blockchain and ensure that assets meet liabilities and you're comfortable with that? Is there transparency from the tokenized equity or tokenized securities issuer that you can understand that if it's a wrapped asset, for instance, that the issuer of that wrapped asset is regulated and is complying with whatever the rules and regulations applicable to it are, but then two, are they actually sending orders to the broker who is then buying the securities and custodying them on their behalf, and is that happening real time, i.e. do you have a mismatch, do you have any issues with that? By design, this because obviously the capital markets are closed during certain hours, and whereas tokenized equities aren't, you can always have these arbitrage and leverage opportunities, which actually create really a compelling market dynamic, and which makes it, I think, very, very exciting for after market news events that hit the wire. Suddenly, you have people like me, a consumer, who's able to actually go in on a Sunday and take advantage of that to the extent there's liquidity in the tokenized asset. And that, I think, is definitely something that we're not seeing yet because it's still very much a nascent industry. Last thing I just relevant, which I think is really relevant in terms of resilience, is for this to all work, and piggybacking off of the trust word, it really, investors have to trust it, and even if there is a market meltdown, which there will be, we're in the markets. These happen. Bull and bears always happen, right? We've just had this ripping bull market. I'm kind of curious to see how investors react, particularly in crypto, when it hits the fan. And we all know it's going to hit the fan, right? Any day, maybe even this morning. And so it'd be interesting to see, kind of from a resilience perspective, how does it all stand up? Meaning that will the tokenized issuers ensure that the transparency that I described earlier and the liquidity that I described earlier is all working, i.e. the pipes and the plumbing are working as designed, or do we have breakdowns due to compliance, regulatory, or just operational risks which are materializing?
Thank you, CJ. Always a great answer from the panel. For our last question, I want to open up a little bit to something that's obviously near and dear to my heart. Standards. Standards is a big one. If those of us who worked in TradFi have really enjoyed standards at scale across many different venues, but clearly in DeFi and in tokenization, there are what we call open standards, a term that I wish I coined, but Karen from the Linux Foundation Decentralized Trust actually coined with the SEC. The idea that standards being originated from communities, blockchains, and all this other stuff. From your seat and your perspective for our last question, how do you see the importance of standards? And when I say standards, I don't just mean token standards like 3643 or others, or vault standards. I mean bigger picture standards that you think we need to make tokenization more risk and resilient. What kind of standards do you think are important? What do you think we need going forward to achieve that goal of risk and resiliency? Charles, please.
I think you're probably the best one to answer this question.
I'm trying not to make it, but yes, please.
So we discussed that. So it's not my focus in my day-to-day, but standards are definitely very useful from the risk angle. I know that the part like for smart contract you said was not the only one you wanted to explore, but as I'm discussing the different risks, like what I was touching on just before, like how you start to have, like for instance in a rating, you have legal consideration. Should you have smart contract or tokenization related consideration? So most people agree that yes. There's also, well, actually I got something to say about standards. When you
They always do.
No, good one. But there's an absolute lack of standards right now. For instance, if I come to you and I say you should have a smart contract audit, right? It's a Hacken event. What is that? Like, there's no real definition. When you speak with players that are reviewing smart contract audit, they're telling you that some are just code documentation. There's not real definition even of what is this. So we need standards for that kind of definitions. We need to have very clearly what is a smart contract audit? As an example, right, it's not the only one. What is a smart contract auditor? Can anybody be that? Do you need a license? Do you need some type of review? And then speaking of standardization from the code angle, well, the more we'll have standardization of the code, we see that, for instance, with the ERC20, the less risk we'll have because, well, these standards are being battle tested and reused.
Yeah, I think blockchain is built on standards. It's impossible to actually kind of build any technology in that industry without standards. Kind of everyone heard of ERC20, etc. But if you look at standards, I think you have these technology standards in the traditional world. I would mostly call it interoperability purpose, interfaces that one piece of software can talk to another one. Then you have also these accounting standards and many, many more standards for processes, etc., etc. And I think that can all basically emerge into standards combining those things on the blockchain, because actually to replace intermediaries makes the system much more efficient. Those standards can actually be put in code, and then it's actually both interoperability, how a token can travel from one smart contract to another, from one blockchain to another, but also what is the embedded functionality, what are the features like KYC, AML, accounting, tax, whatsoever, that can be embedded as another standard in the code. And that is actually a chance we just need to use, and actually eventually it needs to happen to make it a success, I think.
Well, I think if we're talking about smart contracts and smart assets, the standard also has to be smart, in the sense that we cannot think of standards as one thing equally adopted by everybody. The assets now will perform differently depending on what chain they are, what jurisdiction they are, what composition they have. So the standard, I think, has to be procuring interoperability. The assets should be integral in terms of structure, the rights of ownership, compliance, no matter where it operates. So it's going to be tricky, but it requires design, right? So understanding what the standard is for. Is it for compliance? Is it for interoperability? Is it for the use case is very important when it comes to adopting a standard, and is definitely no one size fits all.
I fully agree with that. So we're hyper focused on effectively our public perception, as most companies are, and we want to make sure that we're operating in a level of transparency and protecting customers and what have you. When we do see, for instance, top exchanges published by Forbes or the Wall Street Journal, what have you. We take a look at that and we try to understand what are the KPIs and the KRIs that they're using, and do they really understand our core business? And we've had many conversations with them, and we've asked them, what standards are you applying? How are you risk weighting your rating to come up with effectively the rating that you have? And because of, I'd say, a lack of transparency overall in our space, a lot of times those who are rating us are flying a bit blind. And so we have to then have an education conversation with them, give them a lot of transparency, a lot of information, and then suddenly our rating goes from a 7.1 to a 9.5. And you say, gee, how did that happen? Because you have the information. What standards are you applying? Well, these are the standards. We told you what our standards are. So it'll be interesting to me to see, like as the credit rating agencies, having grown up in TradFi, it'll be really interesting to me to see if there'll be effectively a common denominator that's going to be published, looking at, as Otto said, various different risk vectors to come up with effectively a composite methodology.
Yeah, well said by the panel. And Martin, some of your points I think were really succinct. The reality with the standards that we have in DeFi and blockchain are enormous. I don't think TradFi really realizes how much standards need to be developed across all the different verticals, which is why they want to make it about smart contract standards specifically. When you actually look at interoperability or custody or ratings or even into DeFi, we're only beginning the conversation. We're only even conceptualizing what even those standards mean, especially from non-traditional sources. So I thought that was great. We have a few minutes left, so I don't want to burn anyone with a heavy question, but I'll give everyone kind of time to say some last thoughts on tokenization and risk resilience and what you guys are working on to make that a reality. So Charles, please kick us off.
Okay, well, we'll continue to look at the risk assessment that are missing in the market that we could provide. We're also working a lot on the index side. We did the tokenization of the S&P 500 with Centrifuge. We'll continue to explore new type of indices. The Dinari one was also launched. So if you have any question about if what you're doing could be rated or if you want to be connected with the index team, feel free to come see me after this.
Yeah, I think next step needs to be that rating is more and more integrated in the products, and it's happening real time. We have heard that already a few times. And one of the products I like to mention, we've been starting to work on also with SPDGI is proof of index, how we call it. Basically, bring an index on chain and make actually the index accessible through the blockchain. And that is where basically what an index provider has put into the product and the IP, it's representing to have that protected but transparently available on the blockchain. As one example.
Well, we have focused on collateral, an important piece of the whole system in terms of risk management. You may have followed the collateral experiment that we performed and published. And the second layer to that is working collaboratively with the other DSCPs and FMIs in the implementation of the DSAP, or the Digital Asset Security Control Principles, within the risk framework for mitigation, right? So one is dealing with the asset itself, the other one is really dealing with how the risk is assessed on the asset, and that's what we're focusing.
So from my perspective, what we're trying to ensure is that we optimize the user experience and we provide very clear user interfaces, no surprise. But what that really means in practice is that we want to offer the ability for our clients to trade X stocks, so Tesla X, or buy Tesla on NASDAQ, or do a future, or do an option, and wrap all of that in one seamless way such that, again, I abstract away from them and I don't have them to feel the compliance pain that I have to deal with behind the scenes, but recognize that, for instance, that the SEC has regulation best interests. There's the BSA, there's MiCAR. So my goal is to try to make that as seamless as possible to my clients, so that my clients do have to lean in and they have to provide KYC and make sure they're not manipulating the market consistent with the market abuse directive, et cetera. But we'll monitor all that. But I want to give them like this seamless interface that they can then leverage and optimize for whatever asset that they need that is relevant to their investment or hedging or performance goals, that they have that capability. So for me, as a CCO, that's critically important.
Thank you, CJ. Well, guys, thank you so much for having us. Thank you to our panelists. Please give a round of applause for them.